The Asian markets are likely to be moved by what happens on the US monetary policy, on the US-China trade talks, the growth recovery in China. Our view is recovery is more of a second half oriented. The Indian elections, which is a big event in next 2 months. And finally, the big technical positive which has happened, which is the A-share inclusion and the rising free float factor of A-shares in MSCI benchmarks globally. We believe that Fed would stay dovish for rest of the 2019. What's happened is, with the escalation of the trade war rhetoric in second half of 2018 and slowing down of China in late 18, we saw business conditions almost come to a near freeze level that impacted the investment sentiment, etc. Economic data outside US has been a bit weak, and that's where Fed, being cognizant of all these conditions, has said that it's unlikely to do any further hikes for rest of 2019. The contraction of balance sheet of Fed, which was also an issue for markets, is going to gradually come to an end over the next couple of quarters. Apart from Fed, we have ECB, which is going to continue with the QE. We have Bank of Japan doing the same. So I think with this kind of a benign liquidity outlook, EMs, particularly Asian equities, should continue to do well for rest of 2019. This is a question which is on mind of most investors. How strong would be the rebound in the real economy in China? What we've seen is markets anticipate and position for a strong rebound. Our view is this is no crisis situation in China, but the recovery is going to be a bit slow. The government, the leadership is doing all the right things in terms of giving VAT cuts for small enterprises, in terms of giving tax cuts for the consumers at large, and refraining from any large-scale infrastructure stimulus. But what it means is these more well-measured measures will take a couple of quarters to work their way through the economy. So our view is the recovery in China is going to be more of a second half story. A part of the gains are already baked in. What we believe markets would do is go through a period of time correction. But as markets gets confidence on this recovery, there are further gains to be made. We are a lot more constructive on outcome of Indian elections today than 5 to 6 months back. There was a fair bit of an uncertainty late last year, early this year, on whether the existing government gets voted back. I think post what's happened in recent weeks in terms of the Pulwama attack and again the response the government's given to that, and the way it's been viewed by public at large. A lot of opinion polls today are suggesting that Modi government may get voted back with a near majority. I think that's positive because that gives the government the chance to further this agenda of infrastructure improvement, further the agenda of productivity improvement, do some of these SOE reforms, etc. over next 4 to 5 years. From a market perspective, it gives market the certainty that the growth story would not be derailed. That said, elections always have this bit of an uncertainty, more so in a country like India. So we'll watch for what happens and the outcome comes out in mid-May. We believe that this is going to be a fairly long drawn-out affair. Unlike most participants who were worried that, and this was late last year, who were worried that we're going to see further escalation of tariffs. Our view was the escalation of the trade war stops when US starts getting impacted, and that was happening from last October, November onwards, when most US businesses were citing trade war uncertainty as a reason to slow, put on hold the investments in the economy. I think the government was smart to take cognizance of that, and which is where we saw this beginning of the trade talks. That said, the differences remain huge, particularly on the enforcement of all these conditions, etc., and which is where it's going to be fairly long drawn out. We believe that the worst is behind us in terms of the negative impact from trade talks. Businesses, having seen this over the last couple of quarters, are now adjusting their sourcing to take care of the trade war uncertainty between US and China. And I think markets have also moved on from there. Unless or until we see significant escalation of the tariffs, or the tariffs being extended to almost all imports from China, we don't believe that US-China trade war would have significant impact on markets. We believe it's a fairly significant event. If you ask to compare this event to something significant in history, I think a fair comparison would be China's inclusion in WTO in 2001, 2002. And post that, we saw China's share of world exports move from 3% to 14%. What the A share inclusion does is, and we've seen historically, whenever MSCI has included a new market, they've started with a free float factor, which is usually small, 5%, and in due course, as it gets comfort with the market, the free float factors keeps increasing to nearly about 20, 50, and 100%. Today, with MSCI saying that for A share, kind of an inclusion, they'll move from 5 to 20% inclusion factor over next 1.5, 2 years. This is clearly positive because it puts A share on radar of most global investors. There are good, attractive growth stories in A shares, and investors get an opportunity to participate in those growth stories. From our side, it works to our advantage. Sitting in Hong Kong, we've been investing, tracking A shares for now close to about 4 years, and it gives us a great opportunity to kind of generate significant alpha from some of these hidden gems.